All right. Okay, well, we're going to go ahead and get started then. My name is Doug Wendt, and I'm here to serve as moderator. And I'm really excited to bring you all together for today's webinar on the state of commercial real estate in the Chesapeake Corridor. So joining us, we have Matt Brady, the president and CEO of Brady Renner CPAs, and Scott Douglas, the president and CEO and principal broker of Douglas Commercial Real Estate in Annapolis. So Matt, why don't you take a moment and just say hello, and then we'll do the same with Scott.
Good morning, all. Very excited to be here, and extremely excited to have Scott with us as we're going to just hopefully engage in a spirited conversation about the real estate market, especially on the commercial end, and what the heck it is we're seeing over this goofy year.
All right, and Scott Douglas, take a moment, introduce yourself, sir.
Yes, hi, my name is Scott Douglas, and as Doug said, I'm a commercial real estate broker based out of Annapolis, Maryland. I started my career in accounting, which has been very helpful in commercial real estate, and I've been in commercial real estate since about 17 years now, and like everybody else, I'm just trying to make sense for all the nuttiness and craziness, but hopefully it's starting to come into our rear view mirror. So fingers crossed.
All right, thank you, Scott. So we since we have a small group, we decided to let everyone choose to participate. So as you've come in, we've actually moved you over into more of a Zoom meeting format. So feel free, if you want to interact, you can unmute and turn your camera on and participate actively in the conversation. If you want to just watch and learn, that's fine too. So, but we welcome you to the program. So let me just sort of set the stage for the discussion today. You know, a lot of us in the small business community, including myself, have to make decisions about our real estate from any number of perspectives. You know, if we lease, is this what should our strategy be for the future plans for our leasing requirements? Should we consider switching to potentially owning? Should we invest? If so, what asset classes should we consider? You know, there are a lot of factors that are sort of floating out there that impact all of us, whether we run office-based businesses, whether we run retail businesses, whether we run industrial or other kinds of enterprises. So we're really excited to bring together Matt and Scott, both of whom are focused on serving businesses in this region, in the Chesapeake Corridor, if you will. And with that, I'd kind of like to dig in and let's get started on some of the questions that I think will help us set the stage for our conversation. You know, Scott, let's just start very simply. You know, what's been the impact of COVID-19 on the commercial real estate sector, particularly in the Annapolis, Bowie, you know, in the region?
So, Doug, it's been very, very interesting. Like everybody else, from March until through June of 2020, everything was on pause. And then as the economy slowly started to come back, things just took off in the commercial real estate market. Keep in mind the confluences that were happening. You had low interest rates, and then once the government started printing PPP money, that gave companies funds to work with. So things just started to really accelerate last year. And then since the beginning of this year, things have gone bonkers in a good way. You know, the stock market's back up. People are feeling good about their portfolios. The interest rates are still low, and there's still a ton of stimulus money out there. A lot of companies that I talk to, especially the professional services, your accounting firms, your law firms, the banks, the tech companies, they all had banner years last year. The tradespeople, they all had banner years last year. And, you know, the restaurants, you know, I think that for everyone, that might have fallen by the wayside. And one of the things that COVID did, it accelerated a lot of these things. So if a company was on the margin to begin with, I think COVID might have accelerated their demise. But everybody else who was nimble and pivoted and accepted where we were at and didn't try to fight it, they've survived. So now I think one of the stars that's just really blowing my mind is the retail sector. So, I think that it's great. The economy is doing really well, especially in this region. And, getting back to, and from what I've seen, the profile of the audience, you've got some investors as well as some tenants, as well as current owner users and or potential owner users. So my opinion is that, first of all, moving forward, I think that 2020 showed you what's going to happen, but it's more of a short-term blip. That's not going to be a long-term situation. And so if you've done well, I don't think it's going to alter too much your future plans. So in terms of negotiating a lease, you just got to ask yourself, putting any one-time situations on the side, where do I see myself? Do I need room for expansion? Is my company going to be more remote? And then work from there. And second, I always think it's better to own than lease. Now, granted, I think everybody from the buyer's pool thinks that prices are half price. That's not the case unless it's real estate that deserves to be half price. But when you do your analysis, 99% of the time, from a per square foot price, it's always going to be less expensive to own, and you get all the additional write-offs. So that's been my experience. And again, you got the stimulus money, you've got incentives, and you got low interest rates. So that's all just great stuff from companies that are thinking about buying instead of leasing. And as much as, in terms of renegotiating a lease, I think that landlords appreciate good tenants, but they're not going to, as I said, going to give away the store, because keep in mind that they're trying to just preserve their rental rates, as well as, there's covenants in their mortgages that they're not allowed to do certain things. So all in all, I think that the real estate is pretty strong from all the classes, especially from an industrial perspective. That's just super bonkers. And, where the expectation might be, I'm going to save 40% on my rent, but keep in mind, everybody had great banner years last year. So I think the focus should be, what, we're doing great, and what's going to make the most sense from the company. And the fact that everybody's doing great, it should give people confidence moving forward. Hopefully that makes sense.
Now, I'm just curious, Matt, I know you've been talking a lot and with clients about different strategies for how to manage the accounting impact and the tax implications of real estate. What are your thoughts on some of the recommendations and suggestions that Scott asked or just brought up? How do you feel? I know that we both know a number of business owners who, particularly office-based businesses, that have actually invested in owning their own office condo or owning their own building, but others who had more flexible arrangements have been changing completely to a hybrid or remote model. You yourself have stayed the course with your offices. What's your take for the office side of the market in the small business community?
Certainly, there is no one size fits all. I think everybody's, situation is different. I think you've got to look at a number of factors, one of which being what are your long-term plans and where do you see your business as far as geography, size? Do you see yourself being able to stay in the current space long-term? And if you think you're going to either, outgrow, move, pivot in some, way, shape, or form, is the space that you are in considering, if we're talking about buying, is it something that you think, is well marketable, that it's not, only usable by you, that if you decided to, to move, that you could get somebody else in there if you wanted to maintain it as as an investment property. My my opinion is the jury is still out on my opinion on office condo space. I'd actually be very curious to get Scott's thoughts on it. And this is coming from somebody that that owns his office condo, including another condo unit. You know, I'm kind of back and forth on the investment savviness of, you know, not owning the, you know, outside walls and land associated with a space. You know, so you know, I think uh, if we're talking about you know, owning, you know, an entire, you know, building a space that you're gonna, you know, occupy, maybe be able to, you know, lease out part of it. I think that's, you know, an absolute, you know, great way to go from an investment standpoint. If you got the capital to do it. You know, one of the things that, you know, is, you know, somewhat of a misunderstanding is, you know, you know, the real estate market, I think, is a great economic investment, and there are certainly long-term tax benefits to it. But year one is not this major tax boom, you know, that some people think that it is. You know, there's a lot of upfront capital, and you know, those don't, you know, equate dollar for dollar to write-offs. You know, especially in a market where you're having to put, you know, 20% down on $1 million, $2 million, $2.5 million space. You know, that requires cash, which is exactly why, you know, I think the market's doing what it's doing right now, because surprisingly, we're all well more capitalized now than we were pre-COVID because of a lot of the help. But that's definitely a major factor, you know, to consider, that I do think is sometimes misunderstood. Of, you know, I'm about to, you know, write a check for $250,000, you know, and also think they're going to see a line item on their tax return of $250,000 tax deduction for, you know, deposit on commercial real estate, and it doesn't quite work that way.
Scott, what's your take on the office condo question as opposed to owning the four walls and the land under?
So personally, I own, now they're residential, but I'm actually closing on one today. I own 2 residential condos, and I'm purchasing a third as investment properties. I think from my experience, the office condos, you're not going to get a ton of appreciation, but for somebody who wants that 1, 2, 3,000 square feet, and there's not a lot of single story freestanding buildings available, I think it's a good option. And again, you know, what I always advise my clients is that it's got to make sense from a business perspective. And what I see time and time again, I just got a new listing. It's a 1,354 square foot office condo in Annapolis. I think it's listed at $460,000, and principal, interest, taxes, condo fees, and insurance is about $30,000 a year. And when you look at what you would be paying in rent, it's almost equal. So other than what your down payment would be, you now, for the same price as rent, you're building equity into the property. So from that perspective, and then it comes back to what Matt and I are both saying, each business has its own unique set of criteria. And if you feel you're going to be there 10 to 20 years, then it makes sense. And again, as to what Matt said, and this is why buyers and tenants and companies should have a broker, because they're going to go through the comps. They're going to give you the landscape. So for example, this particular office condo I've just listed, there is nothing for sale and nothing for lease. It's right by the Parole Town Center, so it makes a lot of sense. Again, I'm going to qualify, and if people think that there are going to be all these great discounts in real estate, that's not going to happen. And if you buy now, you're going to make a 50% appreciation over 10, 20 years. That's not going to happen either. If it does, good for you. But at the end of the day, if you're paying less in your mortgage, your debt service, than you would be renting. And 10, 20 years, you get it paid off. Now you've got that asset and you can do several things. You know, you sell your company, they can lease it back, or you can include the real estate in the sale. So that's kind of my take on the office condo market.
No,
I did
go
want
ahead,
to just,
Matt.
you know, add to that because I thought Scott brought up a number of good points. And, you know, one of the things about the commercial space compared to the residential space where there is sometimes more flexibility is on that upfront capital. It is way more commonplace, not that this always happens, but it is way more commonplace for a seller of a commercial property to potentially take back a note on part of the deal, which, you know, almost never happens in the real the residential market. You know, so for example, using, you know, my own situation, when we bought you know, this office condo, and it was a unique situation in the fact that, or maybe not overly unique, but you know, we had been renting it for a number of years, so there was starting to be some history with the owner of you know, trusting in our business and our financial strength. But we were able to buy this unit and another unit that he owned, and he took back a note for 20%. You know, I borrowed 20% from the bank. The bank actually counted the 20% that he was taking back as my equity. And so I ended up not writing any kind of check, you know, other than some settlement costs. So there is some creative ways that you can do in the commercial world from a capital standpoint. And again, to Scott's point, and a lot of times, you know, you do the cash flow math, and, you know, your, you know, note payment ends up being, you know, within, you know, plus or minus 10% of what you were paying in rent, you know, anyway. You know, I have a client, now this is a full building situation, but was renting a building. This is a manufacturing plant. And this is a client that, you know, certainly nobody on this call, you know, a client that, you know, certainly just professed to know it all, and was in a space for 30 years. And when you went back and looked at the numbers, like, I mean, he paid for that building probably 5 times over the course of 30 years. You know, and, you know, that's what you certainly want to avoid. If you're going to be in a space extremely long-term, you know, you got to figure out a way to own that space for sure.
Now, I want to go back to something Scott said earlier that I think is worth digging into, and that's the supply and demand in the market. So my question is this: we've read that, you know, one of the results of COVID is going to be, or has become, the emptying out of downtowns. You know, that the great urbanization has now reversed, and everybody wants to live and work outside the city core instead of commuting in, certainly on the office side. So is that a real factor here, or is that more punditry? You know, clearly there is a lack of product available in a lot of asset classes. Scott, you alluded to that earlier. So what's the story on supply and demand right now, and what are the driving factors, and what is just mythology in your opinion?
So I like the punditry word. That's a cool word. I'm going to hopefully use that later today.
Awesome.
So I think Baltimore and DC are two separate markets. I think that, as I said before, COVID accelerated a lot of situations by several years. The CBD in Baltimore was on a decline anyway. And, you know, again, if you look at, so first of all, the rental market is just super duper crazy in DC. That's starting to come back big time, the rental residential. And at the end of the day, people want to be close to the government. So you've got the law firms, you've got the lobbying firms. I think that the absorption might take longer than what they anticipated, but I think in DC it's going to happen. And what excites me the most about my industry is the way that we're flexible and we're able to pivot. That's what we do on a daily basis. So, you know, I think that the office market's still the biggest variable, and I don't know how that's all going to shake out. I will say that there's still an appetite for good buildings in good locations. And like, for example, if you look at Harbor East, which is right outside of the CBD in Baltimore, they're just rocking and rolling and signing crazy leases. So, and if you think about the millennials, the millennials want to live in cities. You look at what Howard Hughes is doing in Columbia. So I think that as things start to settle down and you've got the millennials living in the city and they want to walk to work, I think at some point that's going to bring back the CBDs.
Do you see a lot of companies switching from having all of their employees in the CBD to going to this idea of having smaller centers in the suburbs, or has that been mostly conjecture up to this point?
So since most of my work is probably the BWI corridor as opposed to downtown Baltimore, so I don't really have an opinion on that. All I can say is that I'm not seeing, and again, in the BWI corridor, you're looking at the 3,000 to 5,000 square foot for office users.
Right.
And a lot of times getting back to, they've all had banner years, and for them to start jerry rigging and trying to break a lease or do all this work, they're just making money and moving forward and going on.
Right.
Hopefully, I know that didn't answer your question directly, but
no,
again,
go ahead, Scott. I'm sorry.
No, that's okay.
Well, and the other thing that I will say is my perspective, my observation on the ground has been big organizations have talked about making radical changes to their workforce, work from home indefinitely, sort of the Google example. But at the same time, smaller organizations, every small business owner I know who's office based, accountant, attorney, engineering firm, architect, etc., they're eager to be back in the office. Maybe they only slightly reduced their office operations or, offered flexibility, but everyone really wanted to be back. Like, I haven't seen the same, radical plan for change in the small and mid-sized business community that at least has been discussed and to some extent implemented in the larger companies. So this loops back around to a question, why is there a tightening of availability? You've talked about, you have people who are looking for space having trouble finding it. Is it because there are so many people who are investing in new businesses? Is this businesses expanding? Like, what are the driving factors in the tightening of supply?
So and again, there's not a simple one sentence answer. So like I said, the one that surprised me the most is the tightening of the retail market. And again, it's coming back to location, location, location. Class A office space in Annapolis is increasing. It's not decreasing. Now, if you want B, C, and D building space, then that's a different story. And again, because most companies that I've talked to had banner years last year, everybody's got this pent up demand. And most people I talk to, they're expanding, they're not contracting. So now, instead of people reducing their footprint, people are increasing their footprint. And again, the one group we didn't talk about is medical. So medical just keeps growing and growing and growing. And that's why the Class A office space, especially in Annapolis. So for example, there's a new 100,000 square foot building that was built last year. I think it's almost at 100% leased. That's nuts. The shopping centers are all filled up. Everybody, and now that we're reaching herd immunity and everybody being vaccinated, again, I don't profess to time the markets, but I think that the next 6 to 12 months, as COVID comes into our rearview mirror, it's just going to be exciting times, barring any crazy new events to happen.
Right. So let me ask you, Matt, what are the downsides or the risks involved in changing your real estate strategy right now? You tend to, I think, be a stay the course or think very carefully before making a new decision kind of advisor, which I think we all are here. But what is your take if a company, you gave one example, someone is going to be in a space for 20, 30 years, obviously makes sense to buy. What are your thoughts on other factors that should drive a client to maybe look differently at their real estate strategy, whether for their business or maybe even to invest? Either side of that equation.
Um, I think, one of the big factors that we already talked about is, is the longevity side. But the other thing is timing. And actually, it was going to be a question that I was getting ready to pose back to Scott to get his thoughts is, with what's going on right now, is there anything to what is going on, a traditional bubble in the fact that is now, is there virtue in patiently waiting and not making a dramatic real estate change right now? Certainly you're seeing it, those that are thinking about investing in vacation destination areas that have just gone, gangbusters. My family does a lot of vacationing in Deep Creek Lake, and I've seen, prices there, go up 80% in the last 12 months. So I guess that would be my one caution would right now in terms of making a dramatic change in real estate strategy is, are we going to be peaking at some point, and is there going to be, a small downturn? And I'm asking the question, not answering the question, but that would be the one, I guess, variable that I would consider. The one thing that I would also offer is I have not experienced within my own client base a universal banner 2020 that maybe in some of the circles that Scott's running in. So certainly I've had a number of clients that have had banner years. I've had a number of clients that were able to stay fairly stable. I've had a number of clients that are still facing a lot of uncertainties, and their cash flow is a little masking some operational uncertainties in terms of their actual industry and market space. And so I guess that would be the other variable that I consider is how much are we still, how close are we to COVID really being in the rearview mirror, and is there still an argument to hoarding some cash right now and stay in somewhat liquid for another 6-8 months? I certainly, from a any liquidity advice that I'm giving right now, I don't think this is a 2 to 3 year strategy. It's just I'm not quite ready to say we're out of the woods quite yet.
That we've declared victory, as it were.
Right.
I would agree with that. I would agree with that 100%. But then, first of all, and when people, and Matt, just, you can't time the stock market, you can't time the real estate market. So if you've got a company, you're busting at the seams, you need to expand, you're looking to purchase. If you're going to say, you know what, I'm going to wait 12 months, and it comes back to what I said earlier, it's got to be a business decision, forgetting what's happened in the past. So if you're confident about your business growing and you need to make a move now, I wouldn't put it off to try to time the market. Now, if everything is doing fine, you love your space, or you're not anxious to get an investment and there's no other compelling reason, then yeah, if you wait 12 to 24 months and if nothing happens, no harm, no foul. But like I said, if you're busting at the seams and you're trying to wait and time the real estate market, what happens if in 12 months or 24 months things are still accelerating and now the prices are 30% more? Don't time the market. Look at your business, look at your cash flow, look at what you're trying to achieve, and then go back to your trusted circle of advisors, your real estate agent, and your CPA, and figure out what's the best course of action.
And Scott, I think you're saying it, exactly correctly. And what I would add, to that, in terms of one other piece of advice that I would give clients is, if this is something that you're seriously considering, whether it be an investment or actually an owner-occupied type of space, what you certainly can do is to get your ducks in a row, so that when the right opportunity comes, you're ready to pull the trigger. Because one thing that is certainly going on right now is, because of the craziness that Scott keeps alluding to, is if you're talking about this, and all of a sudden you kind of find a space, you're like, oh, this seems to be a good space. Maybe I should start to think about freeing up some cash, and getting financing in place, and by the time you're doing all that, it may be too late. So you certainly can't time the market, but if you are actively exploring, you should make sure you've got kind of the pieces in place, so that if you find the right thing, that you can just say, yes, let's do this.
Matt, that's perfectly put, and that includes your other trusted advisor as your bank. So you've checked off that box, and if something compelling does come up, you're ready to pull the trigger. I agree 100%.
And so, Scott, to your point, I'm curious, what are 2 or 3 things that maybe small business owners often don't think about when they're starting to evaluate space options, that you would say, you know what, it may skip your list, but this should be at the top of the list?
Well, that's kind of like that's a kind of a broad question. I'm not evading it, but it is a broad.
It is a broad question. I'm sorry. I'm just thinking about it. You do this for a living every day. Cold from years of experience, what factors and considerations are most important. The one that we all know, other than price, is of course location. So beyond price and location, what are things that maybe the rest of us who don't do this every day often forget about, or don't think of top of mind, that are at the top of your list? If I'm looking at my options and I'm starting to consider the possibility of let's say buying a property from my company or moving to a different location, et cetera.
So what I try to do when I get a new client is definitely manage their expectations. So we're all talking about the crystal ball and what do I do in the future. So if I meet with a client and they tell me, you know what, I'm super bullish, my company is rocking and rolling, I need 3,000 square feet, and I'm going to do a 10-year lease. So so they've covered the bases. Now, if I've got a client and they say, you know what, I need 3,000 square feet, but there's a little bit of uncertainty. So then I'm going to say, well, then here's what we're going to do. We're going to look at second generation space where the landlord doesn't have to put a lot of money into the space, and you could move in without much out-of-pocket costs. And then we'll tell the landlord, you know what, we want a 5-year where we want to get out after 3 if the business shifts. So that's kind of why I said each situation is different, and then same thing with retail. The more you can get a second generation space that has existing equipment in there. So there's just, that's not an easy answer, Doug. So
no, but actually
again,
you gave a spectacular scenario. Like, you got me thinking about something that I know I don't think about, which is the nature of the building's history, the ownership, the configuration of that owner's situation has a lot to do with the flexibility of ultimately being able to make a deal that benefits both parties. I hadn't thought about that.
That's exactly right. Yep. And what I try to tell my clients is it's not a one-way street. If you want the landlord to put $50,000 into the space, you want a 2-year lease, what's in it for him? So, and again, that's how I'm able to guide my clients. If I understand it's a short-term nature, I'm not going to bring him to a brand new building where the landlord's going to have a heavy upfront investment into it.
Mm-hmm. And is that one of the areas where expectations are typically, need to be revised? Is that a common scenario, that small business owner wants the perfect space, but wants a very short term, and that's not realistic in the market? Or is that just one of a laundry list of, things that you're probably thinking, oh, let me explain how this works. Tell us a little bit about that.
It's becoming a little bit more common because, again, there is a little bit of uncertainty. in the marketplace. But, you know, I'm not, like I said, I'm super busy. I don't have the time to spin wheels.
Right.
So I'm pretty specific and transparent when I have that first conversation with a new client. So
Right.
just like I said, if they're telling me that they're not sure where they're going to be in a couple of years, we're not looking at brand new office space or brand new retail space.
Right. We're looking at something that gives us the opportunity to then align expectations and term with something that works for the owner.
That's exactly right.
And, you know, I'm curious, we've alluded to it, but let's just pull it out specifically. So we've had 2 rounds of PPP, you know, tax credits. Every state and jurisdictions had a different rescue package of its own. Some programs are industry specific, others have benefited or attempted to benefit pretty much everybody. So, you know, obviously that's had a huge impact. You know, by and large, one to help everyone continue. For some people, it's been an accelerant, others, it's been a lifeline. But, you know, as that bubble of, you know, support funding starts to wane, you know, are we adjusting appropriately, or are we still sort of living in a space of too much of that cash flowing through and not enough clarity?
I think that's the $64,000 question. And I'm hoping that, you know, like the resident, I'm hoping that people aren't overextending themselves and basing decisions expecting more stimulus money. So that would be very sad if that's what's happening. Now, the residential market, so I'm actually working on my first residential deal, which is I'm helping out a client who's in Europe, and they're having me do the work for them.
Mm-hmm.
And so as I'm getting into this residential market, people are making offers above the ask price with no home inspection contingency and no appraisal contingency. So that means that if you're going to buy a house and pay more than what it's appraising for, so right off the bat, you're underwater. Second, that means instead of putting 20% down, you have to make up that difference for the under appraisal. And third, a home inspection, you know, if it's got structural issues or anything else like that, you've waived your home inspection contingency. So, you know, I think that that might be, and maybe because it's just more emotional purchase decisions than business decisions.
Mm-hmm.
I think that there's going to be a correction in the residential market. The flip side, though, is I just think that there's just a lot of wealth out there, too. You know, this couple that I'm working with, they make a ton of money. And ironically, again, managing expectations, when they asked me, so you're telling me that I can buy a house for more than what it's going to appraise for and take on inspection no inspection contingency and be responsible for that. And I said, look, this is going to sound crazy, but you're going to be in a house for 15, 20 years. That's a young couple with 2 young kids, and you're going to enjoy your life with them. And that's how you have to look at it. So this is going to circle back to what I said in the very beginning. Don't time the market and make your decision based on your business. So there you go.
Whether it's
I'll
your
tell you
business
that-
of your company or your personal business.
Yeah.
That's
I'll tell you
Go
exactly
ahead,
right.
Matt.
the one thing I'd, add to that, and Scott, you experience this more day in and day out, where I'm really only experiencing it as I have a client active in the market. But, you know, I would agree that it would seem as if we're due for a correction at some point, but I'm hopeful, and my expectation is that I don't know that we're due for a complete bust, because as much as the pricing has got crazy and what people are willing to do, especially the residential market, to get into something, I'm not getting a sense that, unlike in 2008, that we're cutting a whole lot of corners on the lending side, in the underwriting side. So I hope we're not heading into a major bust, because there are does seem like there's some better controls in place, not allowing buyers to overreach too bad.
Mm-hmm.
Yeah,
So basic-
and
As the CPA, the information we're supplying, I mean, it's certainly it's not the no doc, subprime mortgages like there was in 2008. There's still a pretty careful underwriting process.
And I agree, Matt. And I guess people who are buying these houses, 50 to 150,000 above ask, again, they're not making $20,000 a year, and at that, lower income level. So if the market, it comes back to, if we have and that's why I tell this one client, 20 years from now, this house can be worth what you paid for it or less. But that's not, if you're going to look at it like that, and if that's going to keep you up at night, then don't make the purchase.
Right. Right. To your point, to both of your points, if the people can absorb the losses that may take place, then absorption is absorption as opposed to catastrophe, to your point, Matt.
You're exactly right. That's a
So,
great way to put it, Doug.
To Scott's point, is that's the difference in terms of what are you looking for? Are you looking for an investment? That's a different thought process than are you looking for a home, whether that's your personal home or your business home. If you find the right space for your business that is going to be able to handle your plans, growth, expansion, that you're going to be able to be there 20, 30 years, and it's the right fit for you, and you're able to basically own the asset as opposed to paying rent. At that point, in year 6, the question of what's this place worth? Who cares what it's worth? This is our space. It's serving our purpose. It's going to continue to serve our purpose. And I'm not, in this particular case, I'm, paying down, a mortgage, and as long as the market doesn't crash, I'm going to get value out of this. So some of it does come down to, what's your motivation? Because if it's truly, I'm looking, for an investment property that I do intend to turn over in 5-10 years, you're looking for a different situation as opposed to I'm looking for my home, whether that's a professional home or, your personal residence.
Yep, I agree.
So I've got one question that I've been curious about listening to this entire conversation, and that is, it sounds to me like there is a lack of product in the market. Again, now I'm not talking about, skyscrapers and large scale office buildings in downtown. I'm talking about in the suburban, high quality suburban market. Is this a time to invest with other people in development projects? Is this should I be thinking more creatively about how to manage my own investments and consider real estate in a community I know and love as a strong potential?
Well, so the tricky part there is in Anne Arundel County, your development period is going to be 2 to 3 years. So, what's going to happen in 2 to 3 years? You're kind of betting on the future there. And it comes back to everybody's situation. So again, managing expectations, if you're going to I tell people, they say, okay, what kind of returns am I going to get on my investments? It's risk reward. So if you're going to get a good property that's got a good tenant and good term, if it's a national tenant, you're probably looking at 4, 5, 6%. And if it's a local tenant that has good credit, you may be looking at 7, 7.5. And then obviously, as things shift, short-term leases and bad credit, then you're going to make 10, 12%, but you're taking more risk. So, development it's a little bit trickier, but, there are, and I've got access to, there's a local group here. It's the Hogan Companies. Actually, it's Governor Hogan's brother, and they do a lot of limited partnership deals. So, that's kind of a no fuss, no muss. So again, that's a little bit out of my wheelhouse, investing in development, but you definitely have to be more sophisticated. It's not like if somebody tells me they want to buy this 5,000 square foot office building in Annapolis, I can give them a very succinct, my opinion of value, where development, that gets a little bit trickier.
Mm. Thank you. Well, I wanted to take a moment and give our attendees a chance to ask any questions. So you're under no obligation, but if you want to, you can either type them in the chat or just unmute and join the conversation. We'll be happy to take a few questions here. Matt, no, I'm sorry. Go ahead, Rick. Yes.
Sure. Just a quick question, and forgive me if you guys cover this, but what about warehouse space? Are we seeing anything, any specific trends in warehouse space, commercial warehouse space?
It's
Great
bonkers.
question.
Yeah.
I have a company that they want to relocate from Las Vegas, and I'm finding a tough time finding them 40,000 square feet. And we can all thank Jeff Bezos for industrial going bonkers.
Yeah.
So that covers anything that is zoned for industrial, light industrial, logistics, anything in those categories.
Correct. I have a little flex condo, flex being office warehouse in Annapolis. I got a cash offer, 93% of the ask price in a week.
Huh. And you don't see that. Obviously, I think that's a long-term trend we're talking about. Period.
Yeah, I mean, now what I saw, I forget the name of it, but there's a new company that's repurposing like Macy's big boxes into fulfillment centers. So let's look at some of the things that are not going to go away due to COVID. And I'm sorry, did that answer your question about warehouse? Did you have any other questions?
Rick, if you want, just unmute yourself again if you want.
Yes, it did. Thank you. It's consistent with what I've been seeing. I just want another data point. Thanks.
Okay. So I forget the name of it, but there's a new company and they're helping the shopping centers repurpose the vacant big boxes to logistics centers. So what's not going to happen? Online retail is not going to go away, and takeout as part of restaurants going forward, that's not going to go away, and remote working is not going to go away. I think those are the three things that started. Well, not I guess the online retailing didn't start with COVID, but the other two COVID phenomena is remote working and takeout for restaurants. Those are two things that are definitely going to stay.
And restaurants or people in the food service industry opting to build or expand operations that are completely without a walking, without a traditional presence. There are a lot of virtual restaurants now being developed, utilizing purely an industrial kitchen. Right. Ghost kitchen.
Yes. That's exactly right. And the other thing too that I think is a benefit or something nice out of COVID is that families are realizing that on a Friday night, it's okay to go to your favorite restaurant, do takeout, eat it in the comfort of your house, and then watch Netflix.
Right. Right. So benefits potentially all around in that case. Win-win.
That's exactly right.
Excellent. Go. Rick, Todd, anyone else? Did anyone else have any other questions to ask? All right. So, Matt, do you have any other questions for Scott? Because now's your chance.
Yeah, I feel like I've got his captured attention. This is fantastic. No additional questions. I just wanted to kind of take the opportunity to thank Scott again for being able to join us here. I think his take on the market in general and specifically in our local geography being kind of the greater Annapolis BWI corridor, it was invaluable. So thank you for being on.
Absolutely.
My pleasure. Thanks for having me.
Thank you, Scott. Thank you, Matt. And just a reminder to our attendees, we will be providing a recording of this program. We'll also publish it along with a blog article that summarizes key points from the discussion. And we look forward to seeing you at future Brady Renner programs and events, including we're planning on some in-person events coming up in the not too distant future.
Yay.
Absolutely.
So exciting indeed.
All right, guys.
All right. Well, thank you all so much, everybody. Have a great rest of your day. And thank you again for joining us. Thanks so much.
You too.
Thank you.
Thanks. Bye.
Thanks, everyone. Bye-bye.
Bye.